So far, we have introduced the concept of money and discussed how the Federal Reserve controls the supply of money by buying and selling government bonds in open market operations. This explanation of the money supply is correct, but it is not complete. In particular, it omits the central role that banks play in the monetary system. But first, recall that the amount of money you hold includes both currency, the bills in your wallet, coins in your pocket, and demand deposits, the balance in your checking account. Because demand deposits are held in banks, the behavior of banks can influence the quantity of demand deposits in the economy and therefore the money supply. So in this section, we will do an example that shows how banks affect the money supply, and then in doing so, how they complicate the Fed's job of controlling the money supply. Let's start our example. Suppose $100 of currency is in circulation. Okay, we simplify the model. $100 is the amount of money in circulation. To understand the bank's impact on money supply, we calculate the money supply in three different cases. The first case is no banking system. Second case is 100% reserve banking system. That means banks hold 100% of deposits as reserves and make no loans. And the third is fractional reserve system. Let's start with no banking system. There is no banking and public holds $100 as currency. So, as you know, there is no other forms of money, no deposit accounts, no checking accounts, no checks. The money supply, the total money supply will be the currency only, which is $100, okay? Which is very simple. Now let's think about case 2. In this case, 100% reserve banking system. So to be concrete, let's suppose that the total quantity of currency is 100 and the supply of money is therefore 100. Now suppose that someone opens a bank, and appropriately called First National Bank. First National Bank is only a depository institution, that is, it accepts deposits but doesn't make any loans, okay? The purpose of the bank is to give depositors a safe place to keep their money. Whenever a person deposits some money, the bank keeps the money in its vault until the depositor withdraws it, writes a check, or uses a debit card to access her balance. Deposits that banks have received but have not loaned out are called reserves, okay? As we make this definition in the previous slides, the banks hold the money in their vault but not loan out is called reserves. Here in this case, since it's 100% reserve banking system, the banks are not allowed to make any loans. So the total reserves, all deposits are held as reserves. So this system is called 100% reserve banking system. We can express the financial position of First National Bank on the T account, which is simplified accounting statement that shows changes in a bank's liabilities and assets. Here is you see on this slide, you see the T account for First National Bank, and the total amount of money in this economy is $100. When you deposit this $100, the liabilities of the bank will change to $100. Why? Because liabilities is the amount the bank owes to the depositors. And at the same time, on the other side of the balance sheet, assets will increase by $100 too, which all of them will go to reserves because 100% reserve banking system, the banks are not loaning out any money. And given this, the balance sheet, we can call this T account as balance sheet too, because the assets and liabilities exactly balance. For this reason, this accounting statement is called a balance sheet. Now consider the money supply in this imaginary economy. Before First National Bank opens, the money supply was $100 of currency that people were holding. After the bank opens and people deposit their currency, the money supply is the $100 of demand deposits. There is no longer currency outstanding because all of them is in the bank's vault. Each deposit in the bank reduces currency and raises demand deposits by exactly the same amount, leaving the money supply unchanged. So that means in this economy, the currency is 0 here, the deposits are 100, so the total money supply is 100. So what changed? If banks hold all deposit in reserve, banks do not influence the amount of money, supply of money in the economy, but the form of money changes from currency to the deposit accounts, okay? So make sure you understand this statement. In a 100% reserve banking system, banks do not affect the size of money supply. They are not loaning any money out, okay? Now let's look at the case 3.1, which is fractional reserve banking. Eventually, the bankers at First National Bank may start to reconsider their policy of 100% reserve banking. Leaving all the money idle in their vault seems unnecessary because if they loan this money out, they can earn some interest and profit on it. And then why not lend some of it out and earn a profit by charging interest on the loans is the big question. Families buying houses, firms building new factories, and students paying for college would all be happy to pay interest to borrow some of that money for a while. First National Bank has to keep some reserves so that currency is available if depositors want to make withdrawals. So there is a requirement, fractional reserve requirement is because if some of the depositors want to withdraw their money, the bank has some amount cash in the vault so that the bank can give the money back to the depositors. But if the flow of new deposits is roughly the same as the flow of withdrawals, First National needs to keep only a fraction of its deposits in reserve. Thus, First National adopts a system called fractional reserve banking system. The fraction of total deposits that a bank holds as reserve is called reserve ratio. Here in this example, reserve ratio is 10%, which is R. This ratio is influenced by both government regulations and bank policy. As we discuss more fully in the chapter, the Fed sets a minimum amount of reserves that banks must hold called the reserve requirement. In addition, banks may hold reserves above the legal minimum called excess reserves. So banks actually doesn't have to only keep the reserve requirement. They can, instead of here $10 in this example, 10% reserve requirement, they can keep 20, that all their discretion. And for our purpose here, we take the reserve ratio as given to examine how fractional reserve banking influences the money supply. Let's suppose that the First National has a reserve of 10%. This means that it keeps 10% of its deposit in reserve, here $10, and loans out the rest, which is $90. First National Bank still has, when you look at the T-Bank account, you realize that First National Bank has still liabilities of $100. Okay, because making the loans didn't alter the bank's obligation to its depositors. Now the bank has two kinds of assets, $10 in the reserves in its vault, and it has loans of $90. The loans are liabilities of the people borrowing from First National, but they are assets of the bank because the borrowers will later repay the loans. In total, First National's assets still equals its liabilities. Let's consider again what is the money supply in this economy. Before First National makes any loans, the money supply is 100 of deposits. When First National lends out some of these deposits, the money supply increases. How? Let's look at what is the money supply? Currency plus deposits. How many deposits in this economy? $100. It's obvious. It's given here, deposits amount hundreds. How about the currencies that is held by the public? It is going to be equal to amount of loans the bank is giving out as loan, which is $90. As you see, what happened in this economy? Now the money supply increased by $90. So, to make this feat seem less miraculous, note that when First National Bank loans out some of its reserves and creates money, it doesn't create any wealth. No wealth. Okay, no wealth. It creates money. That means it makes people able to purchase. Okay, $100 deposits, $90 giving as back to other people. I'm taking, let's say, money from Robert and give it to Tina as a loan. As you see, I give purchasing power to both people in the economy. So it's like creating money, not creating any wealth. So by fractional reserve system, banks are creating money. And loans from First National give the borrowers some currency and thus the ability to buy goods and services. Yet the borrowers are also taking on debt, so the loans do not make them any richer. In other words, as a bank creates the asset of money, it also creates a corresponding liability for those who borrow the created money. At the end of this process of money creation, the economy is more liquid in the sense that there is more of the medium of exchange, but the economy is no wealthier than before. So let's continue. How did money supply suddenly grow? When banks make loans, they create money. The borrower gets 90 in currency, an asset counted in the money supply. 90 in need debt, a liability that doesn't have an offsetting effect on the money supply. A fractional reserve banking system creates money, but not. Let's continue. Let's say this borrower deposits this $90 at the Second National Bank. Initially, Second National Bank T accounts look like this, deposits $90, and since there is 10% of reserve requirement, $9 the bank cannot give as loan. And loans, the remaining, the bank can loan it out, okay? The amount of loan will be $81. Let's look at again the amount of money supply in this system. So it's going to be $100 deposits, $90 that the first bank give it as a loan, and $81 the second bank giving it as a loan. So the money supply still continues to grow because Second National Bank creates an additional of $81 of money. This 81 is eventually deposited into the another bank. It may be. If it's deposited like in this example to Third National Bank, the deposit account will increase by 81 again. 10% of it the bank has to keep it is in the vault, and the remaining the bank can loan it out. So $72.9 will again will be given as a loan to the people in the economy. So the process can go on like this because it's not going to just stop here, because when you spend this amount, that the money that you get loan, it will be someone's deposit in some other banks, and some other banks will loan some amount to the outside again to get some profit. So here is the process. The process continues and the money is created with each new loan. But the question is, how much money is eventually created in this economy? If we let it up until this lending amount decreases to zero, the total money supply will be 1,000. Okay, so in this example, $100 of reserve generates $1,000 of money. It turns out that even though this process of money creation can continue forever, it does not create an infinite amount of money. If you laboriously add the infinite sequence of numbers in the preceding example, you find that $100 generates $1,000 of money. The amount of money the banking system generates with each dollar of reserve is called money multiplier. So here we will have a very simple way to find out how much money can be created by using money multiplier. So how we can get the multiplier? First, let's make a definition. Money multiplier is the amount of money the banking system generates with each dollar of reserve. The money multiplier always equals to 1 over R. In our example, our R is 10%, but in order to find money multiplier, you need to write R in terms of decimal number. 10% means 0.1 if you write it in decimal. Okay, 10% is equal to 0.1. So the money multiplier will be 1 over 1 divided by 0.1. If you do this division on the computer, you will realize that money multiplier is 10. So $100 of reserves So, in response to credit crunch, the Federal Reserve and US Treasury injected hundreds of billions of dollars worth of capital into the banking system. And since we are paying taxes to finance this government spending, we become actually part of this process by paying taxes. The policy succeeded in recapitalizing the banking system and helped restore the lending to normal levels in 2009.